All right, guys, nightly review here, and one hell of a day for the market. So let me get you guys caught up to speed. Close my spreads in Zoom, AMD, and DocuSign this morning. So starting the week off, locking in just about $3,000, and we got Chipotle still, and I added today Spotify and a couple of positions there on the Qs. So good start to the week, guys. And what I did this morning, obviously, huge move today for the market. So anytime you get a gap up like this, not a bad idea to lock up some of your profits and get a little bit of that long exposure off the table. So that's exactly what I did this morning, guys. Got rid of the AMD spreads. I got rid of DocuSign into the nice move here today. And then at the open, we did have some nice strength in Zoom. Good example, guys. You get a gap to the upside, and especially with a credit spread, if you're at 50-60% of your max profit, not a bad idea to take it off the table. See, this kind of fades off here the rest of the day, so it's not necessarily that you would be in bad shape, but never a bad idea to take the profits and run. So we come into the week here, guys, and we got these big old daily squeezes in the SPY and the Qs. So anytime the index is squeezing and we're building up all that energy, there's a probability we get a pretty explosive move to the upside. And as a general statement, that's what we freaking got here today. So both of the indexes up nicely, but the real party today, guys, was in these tech names. So as goes the index, firing the daily squeeze today, goes the individual stocks as well. We got Apple here, right? Very nice daily squeeze getting going. You got Amazon here, a nice daily squeeze getting going as well. So, the question is, we've got the nice squeezes firing here. We're releasing the energy to the upside. Do we get continuation or do we get exhaustion? At this point, guys, that's going to be the name of the game here over the next couple of days. Now, one thing you want to take into consideration is that, as options traders, when we get a move like this, where the market's been running for 1, 2, 3, and then a fourth day with a big fat gap to the upside, think about, guys, the options contracts. I kind of have a general rule of thumb. We want implied volatility to work in our favor. That means if we're going to be buying options naked, in this instance calls, ideally we're buying them before the implied volatility goes through the roof. If we're looking to sell put credit spreads to play the market to the upside, ideally we're going to sell those puts before the implied volatility collapses. So if you look at this move here for the last couple of days and just think about what's going on in the options market, the calls have exploded in implied volatility, getting what we could call overpriced right now, where the puts have basically gotten drained of all their value. So not an ideal time here to be jumping into the market looking for put credit spreads, because the implied volatility crush has already sucked them dry. And then from the perspective of buying these super pumped up calls, God forbid we take a little bit of a breather and chop back and forth, never mind make a reversal back to the downside, you're going to get crushed on that implied volatility crush. So that's why, guys, as a general statement, my goal is I like getting my swing entries near the 21 EMA. That solves a lot of problems, and you can initiate your long position, whether it be naked calls, a debit spread, a put credit spread, but when you can initiate that position near the mean, you're getting the opportunity to lock gains into a day like this morning versus chasing this move and trying to sell puts that have already gotten crushed or trying to buy calls that have already gone through the roof there. So it's definitely something to keep in mind over the next couple of days as far as, options go. But at this point, the big question is, do we get continuation or do we get exhaustion? And for me, guys, I'm a big fan of the squeeze. I've been focusing a lot on the histogram here. So you guys can go check out a couple of my videos on the squeeze to get a little bit more detail on the basics. But as a general statement, guys, when we got the light blue bars down here, it's a sign of bullish momentum. Or in other words, we're releasing energy to the upside. What you'll tend to notice is that as long as we have the presence of that bullish momentum, particularly on the bigger time frames, such as a daily chart, we tend to continue to move higher and higher. When we begin to kind of lose steam, so to say, and we start to see that bullish momentum coming to an end, when those light blue bars are going to dark blue, it doesn't necessarily mean that the move is going to completely reverse, but more likely, guys, that they call it easy part of the move is coming to an end. So, the market will pump in the face of the bullish momentum, but as soon as we kind of lose steam there and those light blue bars go to dark blue, we can end up seeing a pull back to the 21, or at the very least, a little bit of chop. So keep that in mind, guys, over the next couple of days, because, you can make the argument right now that things are extended, and they absolutely are. So my little rule of thumb is that once we're 2 to 3 average true range moves above the old 21 EMA, we're extended. That doesn't mean the market can't continue to go higher, as we saw in months of June, July, and August. Extended can turn into even more extended. So focus on momentum here, guys. I think that's going to be really important. Amazon, Apple, you name it, technically we're extended. Doesn't mean the move has to come to an end. So keep that in mind. We can continue to pump and run further and further and further in the face of the bullish momentum. But on the squeeze indicator here, when on the bigger time frames, like say a daily chart or a 4-hour, the light blue bars begin to turn to dark blue, it's a, call it guys, a heads up that potentially we're running out of gas here and the move might be over with for the time being. So what I suggest over the next couple of days here is, kind of work from the ground up. Let's take the Qs for example. And what we're going to want to see, guys, say you're looking for more continuation to the upside, you bought calls today, you sold some credit spreads, you're looking for continuation. You're looking for a continuation of the momentum. So you want to look at the 30-minute chart, the hourly chart, the 2-hour, the 4-hour, and if you're long right now, ideally you continue to see those light blue bars. If you start to see the dark blue bars in the squeeze histogram, not a guarantee, but a potential heads up that maybe we're losing steam here. So if we take a look at how the Qs here finished into the close, we're pumping all day long with the bullish momentum, but as soon as those light blue bars turn to dark blue, the move kind of gives out a little bit. So that's the 30-minute chart. You kind of want to work your way up here, guys, and we can see the hourly chart starting to show signs of maybe some exhaustion as well. If not, a little breather. The 2-hour chart is still going strong. So very strong market today. We still got bullish momentum all over the 2-hour, the 4-hour, and the daily chart. But it's something I think, guys, to keep in mind over the next few days. Now, if you have long positions, you got to manage your risk. If you don't have positions right now and you're looking to potentially get some, I think, guys, it's a good idea to wait for a potential pullback. I'll be the first one to admit I'm wrong, but as far as just an options pricing goes, I'm not a fan of jumping in here and chasing this after we've already made a significant move. Calls are super expensive. If you're looking to sell puts, there's just not much premium left. So for anybody looking to get long the market right now, I think it's all about waiting for that ideal entry. Whether that be a nice tight squeeze on an hourly, 2-hour, 4-hour chart, whether it be a pullback, different things, guys, to keep in mind here. Calls are very expensive right now. The puts have gotten crushed. Something for y'all to consider. So next couple of days here, guys, for me, take a look at a couple of positions. And as far as, shorting the market, I'm not trying to step in front of the individual stocks, Apple, Amazon. I think it's a bit easier to quote-unquote short the index. So I do still have some long positions. So what I wanted to do today, obviously you got call premium up the wazoo here for the Qs. So what I did, guys, is 2 different sets of call credit spreads. I sold some strikes up at 304, which expire at the end of the month. And then as the market just kept on dancing here today, I took advantage of the premium one more time, getting a call credit spread for next Friday's expiration up there at about 308. So I'll show you guys those positions there on the chain. Right, so this kind of serves, guys, is not just a setup to take advantage of some potential premium decay, but also is, call it, protection. I still have some long positions. I'm still open-minded to taking some new ones on the right-looking setups, but I want to have some protection in the event that the market kind of dies out here and things come back down to earth. Now, what can be nice about getting your hedge with a call credit spread is that you don't necessarily need the market to roll over to get some premium coming in. In the event, guys, the market just kind of stabilizes and chills for the next few days, a lot of that implied volatility crush on those calls will work in my favor. At the same time, though, I still got some good cushion on Chipotle, on Spotify. So the perfect situation would be that the market holds up good enough for the individual stocks to do just fine. At the same time, we can collect some call premium here. So there is next Friday's expiration out there at 308, and then y'all can check out the October 30th. And I'm out there at 304. So that's it, guys, as far as shorting the market here and getting a little bit of protection to the downside. And then for long positions, only one that I added today after I closed AMD, Docu, and Zoom is Spotify. So, I don't want to chase Amazon. I don't want to chase Apple. Puts have gotten crushed. Calls are super expensive. If I'm looking to go long right now, guys, I'm looking for fresh setups. Stocks that are in daily squeezes near the 21 EMA, but haven't necessarily exploded yet. So you look at something like Spotify here, the calls haven't gone through the roof yet, nor have the puts gotten totally obliterated. This looks like a bit more of attractive entry as far as risk reward goes versus something like Amazon, which just went berserk today, up 6% at one point. I ain't chasing into that. Give me a pullback and I'll consider an entry, but as far as, getting into a new position here, I'm liking the daily squeeze here, guys, in Spotify. So went with next Friday's expiration, and let's get the old 21 EMA up here, and I'll show you guys the strike I got, and then I'm gonna let you all go. So Spotify, next Friday's expiration, put credit spread down there at 235 and bought the 230 as protection. So let's pull up the spreadsheet, guys, one more time, and mind you, you can follow me here on FTM Alerts. Look for T's trades. That's where I post my entries and exits in real time. That way you guys can see the screenshots from the Thinkorswim account versus just the old spreadsheet here. But I like my spreadsheet. So let's take a look at those, guys. So on Chipotle, all right, just about 5,000 a max profit between the two of those, though we got earnings coming up, which is a bit of a rookie mistake. We'll talk about that tomorrow. For Spotify, not a big position here, guys. So this is more of an income trade, risking about, I think, maybe it was about 5,000 to make about 1,300 bucks. So we got the Spotify there, and then on the Qs, between those two call credit spreads, looking at about 3,400. So at the moment, guys, between the open positions, just about 9,500 a max profit, closed just about 3,000 today. So at the moment, closed just about 11,000 here so far for the month of October. Again, this is all relative to position sizes and account size, but that's where I'm at right now, guys. So tomorrow, Wednesday, Thursday, Friday, continuation or exhaustion. If you're looking for the market to continue to go higher, you want to continue to see bullish momentum there on the TTM squeeze on all time frames, the 30, the 1 hour, the 2 hour, 4 hour, etc. If we see the opposite, light blue bars going to dark blue, just a potential heads up that the easy part of the move might be over with. So we are extended. It doesn't mean we can't get more extended. Focus on momentum, guys, and I think you'll be able to keep your head above water either way. So I appreciate y'all for watching. If you haven't already, please do me a huge favor and subscribe. And you guys can check us out at focustrades.com and come trade live with me Monday through Friday. So you got the link here for the free trial. And then, as I mentioned, guys, you can check me out on Twitter at FTM Alerts. And that ain't me. Here is me. All right, check me out there, guys, at FTM Alerts, T's Trades, and then on Instagram at Focus Trades. So I appreciate you guys for watching. For everybody in the group, I'll see you guys bright and early tomorrow morning. Have a good night, and I'll talk to you all.